Hi everybody, it's Friday, November 21st, 2025. Our headline is December 25 basis point cut, odds skyrocket to 70%, market barely moves. The December 10th FOMC Fed Funds futures probabilities yesterday were showing, according to investing.com, only a 28% chance of a cut and a 72% chance of no cut. CME Group, I think, said 50-50. Either way, we are now in 70% of yes, we have a 25 basis point cut. The biggest reason for the shift in this probability was probably this article here. December rate cut seems likelier after one Fed official's comments. This is John Williams, not the composer, the other John Williams, the president and chief executive officer of the Federal Reserve of New York, who has more weight in this decision than other members. The reason for the shift in the Fed funds futures matters less than the reaction to it. Remember, part of yesterday's large red candle move down was fear of no cut, and now we have a cut, and this is all the market can do. Go up only 1%, only, what is this, about a quarter of the way up of yesterday's big red candle? If you had just told me about the 25 basis point cut skyrocketing to 70%, I would have assumed a larger snapback in the market. Instead, it barely moved. So if that can't get the markets bullish, then what can? And if we continue to consolidate at the bottom of this red candle after falling a bit, it doesn't look like a pretty chart. Next headline, no CPI for October. It was previously scheduled to be released November 13th, but that was during the shutdown. And they had a quote today coming out. BLS could not collect October 2025 reference period survey data due to a lapse in appropriations. BLS is unable to retroactively collect these data. And while we do have the November CPI coming out on December 19th, this is after the FOMC on December 10th. The important part of all of this is that the FOMC will not be able to react to the CPI of October. They're not going to get it. It doesn't exist. I also think that would normally keep the Fed able to be more hawkish. Again, with this rise to 70% chance of a 25 basis point cut today, it was surprising to me, but it's important to follow what the Fed funds futures do. The Fed basically always does what the Fed funds futures tell them to do. If it's 50-50, then it can go either way, but I don't believe there are many times where the Fed goes away from what the market is expecting. We had also some economic data coming out today. Services and manufacturing PMIs, both above 50. This column here is the actual, this is expected, and this is the last. No large red flags there, but the University of Michigan Consumer Sentiment final for November being at 51. This is basically record lows. It's not updated on the Fed website yet. The lowest that we've seen this before was June of 2022 at 50, which had never been seen before. And now we're at 51, which is, the end of this chart shows 53.6 for October. So you can't see the November line there, but it's basically right in line with this all-time low of July of 2022. Going back to the 1950s, the U.S. consumer has never felt worse. This is lower than the depth of the great financial crisis. I can't stress how important that piece of it is. One of the things propping up the entire economy is the wealth of the wealthier people. They're doing all of the spending. And this is largely because of asset prices having gone up so much. As soon as the stock market starts going down and the only people that are spending all this money start spending less because they look at their accounts going down and their risk assets are losing value. I think we have some disastrous things coming up. Moving on to our community topics. Next week, I'm not expecting to do a Robschild show until Friday. Taking a little vacay. Coming up, the unemployment reports. December 5th, we're supposed to get October's report, December 9th, November's report. These reports will most definitely have an effect on the Fed funds futures, maybe even a very strong effect, as the FOMC is right after the November report on December 10th. Also, don't forget, we always have those tariff updates. Thank you for watching, liking, subscribing, commenting, and supporting Robschild. No changes to the ball ratings. See my free website link in the description to read through my daily reminders, current macro views, portfolio explained, and stock research center. I'm going to repeat what we talked about at the beginning of the show, starting with our S&P 500. That typically good news for a long time has been very bullish for the stock market, sending it to higher highs, higher highs, higher highs. I interpret the increased chance of a cut as being very good news for risk assets, and with this small bounce here, that's very concerning. What kind of good news, by the way, are we supposed to look forward to or get in order to break out of this downtrend at this point? What does Mr. Market need? Going from no cut to yes, there is a cut is a pretty big shift. And if that wasn't able to turn the market back onto a bullish mode, then what can? What will? A 50 basis point cut? If the reason for even a stronger cut is because the jobs market is completely falling apart, remember, there are periods when bad news is good news is bad news. There's periods where good news and bad news is good news. And then you have periods where bad news is bad news and good news is not good enough and therefore bad news. We may be entering that stage. The VIX today closed at 2342, above 20. We're in a zone that can easily send the market lower. Also, the VVIX was in panic zone today, dropped slightly down below 120, which is rising uncertainty. Not close to what I consider to be a normal zone between 85 and 105. Next, the 10-year Treasury note yield dropped today. With this falling and the 2-year Treasury note yield falling, it piles on to the question, why didn't the stock market go up more today? I want to also note that the 10-year Treasury note yield found a intraday low that we haven't seen since the end of October, but not yet meaningfully breaking out of this sideways chop yet. Junk bonds compared to government bonds went a little flat, suggesting credit markets are still not worried about junk bonds defaulting. And with that said, the Fed junk bond spread, like we talked about previously, Tuesday found a higher high that we haven't seen for a while. We haven't seen it since June at that level. And we're also seeing investment grade corporate bonds starting to spread. The AA bond spread, as seen in the Fed today, we got an update that it rose to 50 basis points. And similarly, we have not seen this level of a spread since June. By no means is this very high, but it's rising. Next up, Bitcoin. As I record, it's down 2.6% today, around 84,000. Intraday, we hit around 80,600. Currently, with this shadow below, there's still a chance that we can rise back up to this yellow line, which represents the bottom in August 2024, connecting to April of 2025. We cracked through it. We're fairly obviously confirming below it. This is on a daily and a weekly. Just to take a glance at the weekly, as long as Sunday night close is below 93,000, then this is very bearish looking, but it also doesn't negate the possibility of going back up to 97,000, 96, 97. which will act as severe resistance. I will be shorting Bitcoin if we rise into that. Probabilities strongly favor Bitcoin is headed to the $74,000 to $76,000 range for some chartists, and for others all the way down to the 60,000 zone. As mentioned yesterday, some chartists have been noting that we, on the weekly time frame, have closed below the 50-week moving average, and it looks like we're getting a pretty strong confirmation to the downside. Bitcoin has never done this, apparently, without going all the way down to the 200-week moving average, which right now is around 55,000. I mentioned that altcoins total 2, all cryptocurrencies minus Bitcoin, has been looking surprisingly strong, relatively speaking, to Bitcoin. Today makes it look a little bit more bearish. We're down 4% in total too, with building momentum to the downside. Commodities are still not convinced of anything the way that I see it. Crude oil still in this sort of sideways chop. It's been falling. Chart is better than me. Again, some of them are looking at this as a cup and handle, so slightly bullish. I don't see this as a cup and handle that is slightly bullish. We're now very obviously below 50% of the cup. But more importantly, we haven't broken out very, to a large extent any which way yet. And similar thing going on again in copper with a PhD in economics. Copper is a really important thing to keep an eye on. It tells you exactly what's going on with the demand of copper, which is the backbone to the world economy. Is the world building more infrastructure, more equipment? Do we need lots more copper or not? The chart of gold has also been getting very interesting, consolidating with lower highs and higher lows. Which way will it break? Nobody knows. I also wanted to bring up RSP, equal weight index of the S&P 500, which makes the stock market look like it got a larger bounce than the market cap weight, but definitely not bullish looking after all this red candle engulfs past 2 trading days. Today's candle close and open were on the inside of this red candle. That's an inside bar. That's actually typically bearish. Same thing going on in the IWM engulfing the past 4 trading days, also with an inside day of a bearish candle. I also found it noteworthy that the healthcare industry today closed above the topping tail candle wick of Thursday the 13th. This is pretty bullish looking, a lot better looking than the S&P 500. Right now, on a closing basis, we're up 21% from May's lows, and there's nothing bearish looking about this chart. Another one that caught my eye was XLP Consumer Staples. Yesterday's green candle breaking out of this roller coaster ride that I've been talking about on the show previously, I thought was mostly because of the Walmart earnings, but that continued today. So we no longer have an obvious wavy pattern of higher highs, higher lows. With this sort of break higher, it's starting to look like, hey, maybe are we forming a base here? The momentum to the downside is clearly slowing at this point. So this could turn into a base. If you're not subscribed already, I recommend doing so, especially since I'm not planning to do any shows until next Friday. I may try to squeeze in a post here or there on YouTube. It's also possible you might not hear from me at all. It's mostly because I'm not sure if I'll have much access to the internet over the next week. But that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching. Happy Thanksgiving, everybody, because I don't plan to see you till then. And until next time, Robschild.